Welcome back to Be Open to Wealth. You want a portfolio that performs when economies are growing. You also want a portfolio that protects you when economies are contracting. This is the fundamental challenge for every investor. The goal is to build a financial structure that can survive anything the market throws at it, from soaring highs to devastating lows. This is not about timing the market. It is about acknowledging that we cannot predict the future. The three-bucket method is a simple yet profound framework designed to achieve this very goal. It divides your capital into distinct components, each with a specific job, creating a balanced and resilient whole that works in any economic season. This method provides a clear, logical path. It removes emotion from the decision-making process by establishing rules before a crisis hits. The structure is built to endure both inflation, deflation, strong growth, and deep recessions. It provides liquidity when you need it, stability when markets are volatile, and growth to outpace the rising cost of living over the long term. The first bucket is your fortress of liquidity and security. Its primary and only job is to protect a portion of your capital from any market volatility. This is your emergency fund expanded to become a strategic part of your overall portfolio. This bucket should hold enough cash to cover your essential living expenses for a period of 3 to 12 months. The exact duration depends on your personal situation, the stability of your income, your family's needs. This money is not meant to generate high returns. Its return is the peace of mind it provides and the options it creates during a downturn. Hold the most stable and easily accessible assets available. This includes high-yield savings accounts, money market funds, very short-term government bonds, or treasury bills. The goal is zero risk of principal loss. When financial markets are in turmoil and other asset prices are falling, this bucket remains steady. This allows you to meet any unexpected expenses, a job loss, a medical emergency, a major home repair, without being forced to sell your long-term growth assets at the worst possible time. It is your financial shock absorber. The existence of this bucket allows you to take calculated risks elsewhere in your portfolio. Knowing that your immediate needs are covered gives you the psychological fortitude to stay invested, view downturns as opportunity, and maintain the discipline that is critical to long-term success. The second bucket serves as the stabilizing core of your portfolio. It is a bridge between the absolute safety of your cash reserves and the higher volatility of your growth assets. The primary objectives are to generate consistent income and to provide a counterbalance to the stock market. When stocks fall, high-quality bonds often rise in value, cushioning the overall portfolio. This bucket is for medium-term goals, roughly 3 to 10 years away. Preserve capital while allowing modest growth. It is primarily composed of fixed income, a diversified mix of high-quality government and corporate bonds. Blend maturities, short, intermediate, long, to balance rate risk and yield. Example: a total bond market index fund. Add TIPS, Treasury inflation-protected securities, for inflation protection. For retirees, a regular stream of cash to cover living expenses, reducing the need to sell other assets during downturns. For younger investors, interest payments can be reinvested automatically, compounding steadily over time. This bucket is a reliable workhorse with less drama than stocks. In 2008, stocks plummeted while U.S. Treasury bonds rallied. A balanced investor saw far smaller losses than an all-stock holder. Diversification manages risk and smooths returns, so your journey does not depend on unpredictable equity swings. This is the bucket designed to do the heavy lifting for your long-term financial goals. Its explicit purpose is to grow your capital at a rate that outpaces inflation over many years and decades. Here is where you take on calculated risk for higher returns. Expect volatility. Values will fluctuate, sometimes dramatically, but over long horizons, these assets create genuine wealth. This bucket is for money you will not need for at least 10 years. Core, a globally diversified portfolio of stocks. Do not concentrate in a few companies or one country. Use low-cost index funds and ETFs to gain exposure to thousands of companies and geographies. U.S. large cap, U.S. small cap, international developed, international emerging. Consider real estate via REITs and a small allocation to gold. Once you understand each bucket, the next step is to determine the size of each. This allocation is the most critical decision you will make. Base it on your time horizon, your financial goals, and your psychological tolerance for risk. A younger investor might allocate 60% or more to growth. Someone nearing retirement increases safety and income to protect capital. A balanced starting point: 10% safety, 35% income, 55% growth. Do not buy just one bond or one stock. Use low-cost, broad market index funds and ETFs to spread risk across thousands. Bucket 1. High-yield savings. Bucket 2. Total bond market index. Bucket 3. Total US, total international, and a small REIT slice. Markets move, allocations drift. Rebalance at regular intervals, perhaps annually. Sell some winners, buy underperformers, systematically selling high and buying low. Major life events should trigger a review of your allocations. As you approach retirement, shift gradually from growth to income and safety, a glide path that reduces volatility before withdrawals. Your portfolio is a dynamic machine. Periodic tuning keeps it running smoothly. The most sophisticated portfolio is useless if you cannot stick with the plan under stress. Your own behavior is the greatest threat. The three-bucket strategy is logical, but discipline makes it work. When fear surges, rely on rules you set when calm. Trust the design. Costs and taxes drag returns. Favor low-cost index funds and ETFs with low expense ratios. Be strategic about asset location. Hold less tax-efficient assets like corporates in tax-advantaged accounts, such as a 401k or IRA. Let growth compound tax-deferred or tax-free where possible. Consider tax loss harvesting. Consult a professional if unsure. First, take inventory and calculate monthly expenses to size your safety bucket. Second, define goals and risk comfort. Set income and growth targets. Third, choose low-cost funds for each bucket. Fourth, write your rebalancing plan. Finally, start today. Even a small amount is enough. The three-bucket blueprint is simple, robust, and effective for bulls and bears, growth and crisis. It separates capital by purpose, lets you take appropriate risks while keeping a foundation of security. Now, build the structure, trust the process, stay disciplined, automate, check in periodically. Let your well-designed portfolio do the work for you over the long run. Thanks for watching.